Baba's cloud and AI segments are driving long-term investment interest. Hello and welcome to Inside AI Brief Setai. Today we're talking about Baba stock. Before we begin, please don't forget to like, share, and subscribe. Welcome back to the deep dive. Today we are undertaking, well, a really critical mission, trying to understand the huge strategic pivot happening right now at Alibaba with Baba.
Yeah, it's a big one.
We've got the latest unaudited results for the quarter ended June 30, 2025. Right here, it's Q2 of their fiscal year 2026. And they really show a company wrestling with a deliberate financial conflict, you could say.
It really is a story of trade-offs, isn't it? I mean, if you just glance at the headlines, you see these mixed short-term financials. Profit down in some key areas, cash flow reversing.
Right.
But then you dig into the strategy and you see, accelerating growth in the businesses that Alibaba sees as its future.
So our goal today is really to connect those dots for you, the learner. How does the massive cost of their new strategy, especially in cloud, and this quick commerce push,
how is that designed to generate, hopefully, exponential returns down the line? We're basically unpacking this tension between, let's call it short-term pain and long-term gain.
Okay, let's unpack this then, starting with part one.
Yeah.
The recent performance and financials for Q20 2025.
Mm-hmm.
So the initial headline revenue number, RMB 247,652 million. That's about, what, $34.57 billion US?
Yep.
And that represents what sounds, well, kind of slow on the surface, a 2% year-over-year increase. For a company like Alibaba, that 2%, it looks like maybe a mature giant slowing down.
And that's exactly why we need to, dig a bit deeper than just the press release headline. That modest 2% figure, it's actually pretty misleading.
How so?
Well, it includes revenues from businesses that Alibaba has either sold off or is de-emphasizing. We're talking mainly about Sunart and InTime, those retail holdings.
Okay.
What's really fascinating here is that once you strip those out, right, and look at the comparable, the like-for-like core operations, the revenue growth jumps. It leaps up to a much healthier 10% year over year.
Okay, so double-digit underlying growth. That's a crucial distinction. It shows the core business is actually still growing pretty solidly, but that health is sort of masked by this portfolio trimming.
Exactly.
Now let's talk profitability, because this is where the picture gets, well, really confusing, I think, for short-term investors.
Yeah, it's a real study in contrasts, and it's kind of fueled by accounting principles. If you look at their net income reported under GAAP, that's generally accepted accounting principles, it's surged. An impressive 76% year over year, hitting RMB 42.38 billion.
Wow, 76%. That looks like a massive win for profitability on paper.
It does, but here's the aha moment, the thing analysts really latched onto. That huge surge wasn't because they were selling more stuff or running their core operations better.
Right, not operational then.
Precisely. That phenomenal jump was driven almost entirely by, let's call it non-operational, non-core activity. We're talking accounting maneuvers, basically.
Like what specifically?
Mark-to-market changes from equity investments they hold that went up in value, and also a pretty significant one-time gain from selling off Trendyol's local consumer service business.
Okay, so financial gains, maybe non-cash, some of them, but not reflecting the day-to-day health of their e-commerce or cloud businesses.
Exactly. They don't really tell you about the engine's performance.
So if we filter those one-time events out and look at the core operational view, the non-GAAP net income, the story completely flips, right?
Completely flips. The non-GAAP net income actually decreased, down 18% year over year to RMB 33.51 billion.
18% down.
And the adjusted EBITDA, which, is often seen as the purest look at operational health because it strips out stuff like depreciation and amortization that also decreased, down 14% year over year.
So revenue's growing 10% like for like, but operational profit is dropping sharply, 14 to 18%. Why the disconnect?
That drop, that 14 to 18%, that's the cost. It's the explicit budgeted cost of their current strategy. Management is, intentionally sacrificing current profit to fund two big areas.
Okay, what are they?
One, intense user acquisition and heavy investment in this Taobao instant commerce. And two, massive, really front-loaded spending on cloud and AI infrastructure.
So pouring money into short-term marketing and long-term CapEx.
You got it. And that immediately hits your operational margins. So for you, the learner, this means the company's financial results right now are mainly a function of their strategic capital choices, not just a simple reflection of market demand.
Okay, that makes sense. Let's break down which segments are actually pulling their weight. Because that 10% growth isn't uniform across the board. The cloud intelligence group that's positioned as their future engine, right?
Definitely a key future engine.
How to do it.
It saw revenue grow significantly, up 26% year over year to RMB 33.39 billion. That's a huge acceleration compared to that headline 2% number.
26%, that's strong. What about the profit in cloud?
This is where it gets really encouraging for the long term. They hit a crucial efficiency milestone this quarter. Not only did revenue jump 26%, but the Cloud Intelligence Group's adjusted EBITDA also increased by 26%. It reached RMB 2.95 billion.
Same growth rate for revenue and profit. What does that tell us?
It means that even though they're ramping up investments in advanced tech and AI innovation, which usually drags margins down, they're actually improving operational efficiency fast enough that the revenue growth is translating directly into profit growth in that segment.
So they're scaling smartly, not just, throwing money at it expensively.
That's the key takeaway for cloud this quarter: smart scaling.
And that sustained acceleration, especially, you mentioned this earlier, their AI-related product revenue has shown triple-digit year-over-year growth for 8 straight quarters now.
8 consecutive quarters, yeah.
That really seems to validate their pivot toward being an AI-first company. But there was another big efficiency success story this quarter, wasn't there? The international arm.
Absolutely. The Alibaba International Digital Commerce Group, or ADC, total revenue there grew strongly too, up 19% year over year.
19% internationally. Okay.
But the real story with ADC isn't just the growth, it's the profitability. Or rather, the lack of losses.
What do you mean?
ADC's results are, well, honestly, a stunning turnaround in execution. This segment used to be a bit of a money sink, right? Growing fast, but costing a lot. Now, its adjusted EBITDA moved aggressively toward break even. They managed to narrow their loss by an astonishing 98%.
98%. From what to what?
From a loss of RMB 3.7 billion in the same quarter last year, down to just RMB 59 million this quarter.
Wow. So they're basically running their entire international digital commerce business almost at breaking now.
Pretty much. That's huge progress.
Eliminating nearly all those operational losses in a fast-growing international segment. That's incredible. What drove that? How did they do it? And should we trust that it's sustainable?
The sources point to 2 main things: better investment efficiency, spending smarter on marketing and growth, and really sophisticated logistics optimization.
Logistics, like shipping costs.
Exactly. Especially effective in AliExpress's choice business model, where they curate inventory and offer fast delivery for cross-border stuff, and also in Trendyol's international expansion. They've used scale and tech to cut shipping costs, improve fulfillment, basically turning a high-growth but high-cost unit into something much leaner.
So the takeaway there is they know how to scale profitably when they really focus on efficiency.
That seems to be the case, yes.
Okay, so we have 2 future pillars. Cloud and international commerce both showing strong growth and improving efficiency. That means the overall 18% drop in operational profit. It must have come entirely from the domestic core business, right? The Alibaba China e-commerce group, which has Taobao and Tmall.
That's exactly right. That domestic core, the, engine room of the company, it still grew revenue by 10% year over year. So the top line there is still healthy.
What drove that 10%?
Mostly growth in what they call customer management revenue, or CMR, which for anyone listening is basically the money Alibaba makes from sellers paying for ads and performance marketing on the platform.
Okay, ad revenue.
Right. And that growth came from an improved take rate, the percentage of sales they capture, and also more sellers using their proprietary marketing system, Tui.
So the marketplace itself is healthy. Sellers are spending money. But the operational profit for this segment still plummeted by 21%.
Correct, down 21%. That's the direct price tag for this quick commerce mandate we mentioned.
Right, the Taobao instant commerce push.
Exactly. The decline in the core segment's adjusted EBITDA is the clearest evidence of just how huge the investment is to launch and scale that service. They're spending aggressively on subsidies, building out on-demand logistics, acquiring users.
Trying to compete with Pinduoduo and JD on that really fast delivery, high-frequency shopping.
It's a battle for the Chinese consumer's daily wallet. And Alibaba is clearly willing to pay a heavy price and current profit margin to win, or at least compete strongly in that space.
Okay, now let's look at the financial metric that probably shocked the market the most and directly reflects the cost of this whole strategy: free cash flow, FCF.
Yeah, this one was a big headline.
We know net cash from operations was down 39%. But the reversal in FCF, it's described as seismic.
It really is. And this is such a critical number for understanding the future outlook. FCF, it's the cash left over after they pay for capital expenditures. It's the money for buybacks, dividends, strategic flexibility.
And it went which way?
It completely reversed direction. It swung from a pretty significant inflow of RMB 17.37 billion in Q2 of last year.
Okay, inflow.
To a massive outflow of RMB 18.81 billion this quarter. That's about 2.6 billion US dollars going out the door in FCF.
Wow, that's a swing of over 36 billion RMB year over year. From positive cash generation to burning cash. That suggests, well, not just routine spending, but a monumental deployment of capital.
It absolutely does.
What is that capital buying? Where did the cash go?
The sources are crystal clear on this. The FCF decrease was attributed directly to just two things. First, the enormous ramped-up capital expenditure on cloud infrastructure.
Meaning buying servers, GPUs, building data centers.
Exactly, all that specialized hardware needed for AI. And second, the operational investment in Taobao instant commerce, building out the logistics, acquiring the customers.
So if you look at the Q2 financials overall, the story isn't really one of operational failure. It's more like strategic, aggressive funding. They're almost cannibalizing their own short-term cash flow to become a major AI cloud player and dominate quick commerce.
That's a perfect way to put it. They are trading today's cash for tomorrow's perceived dominance in these key areas.
And this explains the valuation context too, right? The PE ratio currently around 21.38.
Absolutely. That PE ratio and also the price to book, they reflect the market's skepticism or maybe just caution about the short-term financial pain. That's why the valuation is still, 34% below its historical average? The market is essentially penalizing that FCF reversal. It's demanding proof that these huge investments will actually translate into sustained superior profit growth down the road.
Okay, let's pivot now to part two. The business outlook and the strategic drivers behind this monumental spending. CEO Eddie Wu has been really emphatic, hasn't he? Narrowing the focus to just two historic opportunities, consumption and AI plus cloud.
Yeah, that clarity is key. And they've restructured internally to match that focus, consolidating Taobao, Tmall, Ila.me, their local services arm, and Fliggy for travel, all into the new Alibaba China e-commerce group.
Aiming for synergy.
Right. Leveraging supply chains more efficiently, but also, critically, unifying their membership base, their premium 88 VIP membership. It's now over 53 million members.
53 million, that's a huge engaged base.
Exactly. And a base they can now cross-sell quick commerce and local services to much more effectively under this unified structure.
Let's spend some serious time on the AI and cloud pillar, though, because this is where the commitment feels almost existential for the company's future narrative.
It really does.
We already noted that triple-digit YoY growth for AI-related product revenue for 8 quarters. But the forward-looking investment figure, that's what really jumped off the page for me.
It's the headline number for their future ambition, no doubt. Alibaba plans to invest at least, and they emphasize the at least, RMB 380 billion,
which is roughly
approximately 52.44 billion US dollars, into cloud computing and AI infrastructure over just the next 3 years.
$52 billion in 3 years. That figure is so huge, it needs context.
And they provide it. They explicitly stated this amount is more than the company invested in that entire sector over the preceding decade.
More in 3 years than in the last 10. Wow, that's an acceleration of capital deployment that's almost unprecedented for them.
Yeah.
But can they afford it? Can they afford to bleed cash and spend capital at this pace, especially when competition from AWS, Microsoft Azure, even Tencent Cloud isn't exactly slowing down?
Well, from their perspective, they view it as a non-negotiable cost. It's the price of admission, maybe even leadership, in the next era of computing. They're not just trying to keep pace, they seem to be trying to set the pace, at least in Asia.
So that $52 billion, what exactly does it buy them in this AI race?
It's necessary to secure the really high-demand resources. Primarily, we're talking high-end AI chips like NVIDIA's GPUs, which are scarce and expensive. It's also about attracting top AI research talent globally. And of course, building these massive, sophisticated data centers that can handle the demands of their own foundational large language models, like Qwen.
So this spending is the foundational bet. Without this level of CapEx, they simply can't maintain that triple-digit AI revenue growth they've been seeing.
That seems to be the logic, yes. You have to build the capacity to capture the demand.
And is there any sign this massive investment is actually working? Is it gaining recognition?
There are signs, yes. Alibaba Cloud was specifically highlighted in a recent Omdia report, Market Radar, Gen AI Cloud Titans in Asia and Oceania 2025.
What did Omdia like?
They were recognized for offering full-stack Gen AI solutions, meaning Alibaba controls everything from the hardware layer right up to the application layer. That full-stack capability, plus their developer-friendly platforms like Model Studio and PAI platform for AI Omdia, thinks this positions them really strongly to capture enterprise AI demand in the region. They're offering the tools to build and monetize AI, not just the basic infrastructure.
And this strategic commitment, this huge spending plan, it seems to have dramatically shifted how analysts are looking at the company, right? Morgan Stanley, for instance.
Oh, absolutely. They seem entirely convinced by this ramp up in CapEx. Morgan Stanley substantially raised their cloud growth projections. They're now forecasting growth accelerating to 32% in Alibaba's fiscal year 2026.
Okay, 32%.
And then spiking dramatically to 40% growth in FY 2027.
40% growth in cloud by FY27. That sounds incredibly aggressive, especially given the global and domestic competition. What specifically justifies that kind of optimism? A near doubling of the growth rate in just a couple of years.
Well, Morgan Stanley directly ties that optimism to the capital expenditure increase. They actually raised their estimate for BABA's annual CapEx from around RMB 108 billion a year up to RMB 135 billion per year.
So more spending equals faster growth, in their view.
Their argument is that this spending will directly fuel faster deployment of AI models, like their new flagship Qwen 3 Max model, and provide much greater capacity to serve external clients, both in China and internationally.
Speaking of international, what are the other drivers?
Well, the success of those proprietary model upgrades, like Qwen 3 Max, which is designed to compete globally, and also their aggressive international expansion on the data center front. They've already got new data centers planned for key regions like Brazil, France, and the Netherlands.
So building a truly global cloud presence, not just China-focused.
Exactly, to serve those multinational clients who need local infrastructure and data residency.
Okay, let's shift to the other strategic pillar, consumption. And specifically, this quick commerce mandate, which seems to be where all the short-term profit pain is centered. They launched Taobao Instant Commerce in late April 2025. What's the scale of the ambition here?
The ambition is huge. It's really about fundamentally redefining where and how Chinese consumers do their daily shopping. They're targeting that massive market for on-demand delivery, groceries, food, quick electronics, daily essentials.
And what's the market goal they've stated?
Alibaba has publicly stated a really massive market goal. They aim to increase their gross merchandise volume, GMV, by about 1 trillion RMB per year within 3 years. Just through this initiative.
1 trillion RMB. That's about 138 billion US dollars per year in new GMV within 3 years. That's a substantial amount to capture so quickly.
Right.
How do they justify the investment cost, the thing that caused that 21% profit decline in the core e-commerce segment?
They justify it by pointing to the sheer size of the total addressable market for this quick commerce sector. They estimate it's around 30 trillion RMB in China.
30 trillion RMB. Okay, huge market.
So their argument is they simply cannot afford not to spend aggressively to seize a significant chunk of this market, especially since this is the high-frequency retail space, the things people buy often. Winning here is crucial for maintaining consumer loyalty and engagement across their whole ecosystem.
And the investment is going into?
Primarily building out complex, high-speed logistics, including cold chain infrastructure for groceries, and also, very importantly, heavy subsidization right now to acquire users and change shopping habits.
So basically paying people to try the service.
To some extent, yes, that's typical in these high-growth market grabs, and the strategy is already showing results, at least in terms of engagement.
What are those immediate, tangible results from this cash burn?
Well, the sources noted something quite remarkable. These investments led to a 25% year-over-year increase in monthly active consumers just on the main Taobao app in the first 3 weeks of August alone.
25% jump in users in just 3 weeks.
Yeah, a massive surge in engagement. It demonstrates that consumers are responding positively to the quick commerce offerings, even if the service is currently being subsidized and is therefore, profit negative for now.
So they are succeeding in attracting users, but it's coming at the expense of current operational health.
That's the trade-off in a nutshell.
Okay, we absolutely have to discuss the risks here. Because despite the strategic clarity, there are these long-standing geopolitical and competitive pressures that definitely temper investor enthusiasm.
Oh, the risks are significant, and they hit directly at the 2 pillars we've just been discussing: cloud AI and consumption.
What's the biggest geopolitical risk?
It's the one that's been hanging over them for a while. The long-standing threat that the U.S. could potentially blacklist Alibaba Cloud due to cybersecurity concerns or broader U.S.-China tensions.
And cloud is now what percentage of revenue?
It's about 11% of total revenue currently, but remember, it's the engine where analysts are forecasting that future 40% growth. So any U.S. action against the cloud business could severely impair their long-term growth story and dramatically depress their valuation multiples.
It puts a cloud, no pun intended, over that whole $52 billion investment.
It absolutely does. It creates a ceiling of uncertainty.
And domestically, the competition isn't easing up either.
Not at all. The domestic competition, particularly from Pinduoduo, PDD, and JD.com, remains incredibly fierce. PDD especially, with its super efficient, discount-focused model, and now its global expansion with Temu.
Right, Temu is everywhere.
It's forcing Alibaba to spend these massive amounts of money, like the cash pouring into Taobao instant commerce, just to defend its market share in China. They're effectively fighting a multi-front war, high-end AI cloud globally, and this high-frequency, lower-margin, quick commerce battle domestically.
Okay, so huge investments, significant risks. But despite this risk profile and that negative free cash flow, the company is also demonstrating confidence through its commitment to shareholder returns, specifically buybacks.
Yes, and this is a really crucial countersignal to that FCF reversal. During Q2, they repurchased 56 million ordinary shares. That's equivalent to about 7 million ADS, spending $815 million.
Okay, nearly $1 billion in buybacks in one quarter.
But more significantly, they continue to signal confidence in the stock's valuation. As of June 30th, they still had $19.3 billion authorized under their current share repurchase program.
$19.3 billion remaining.
And that program runs through March 2027.
Why is that authorized buyback figure so important for you, the learner, to understand?
Because it acts as a very clear, strong potential floor under the stock price. Management committing $19.3 billion means they are prepared to step in and aggressively buy shares if the price drops significantly. It essentially confirms their own belief that the stock is intrinsically worth more than where it's currently trading. It's a powerful tool to stabilize the market, especially during these times of strategic transition and, well, profit sacrifice.
And quickly, on dividends, you mentioned buybacks are the main return mechanism, but they do pay a dividend.
They do. It's not really a yield play, obviously. The trailing 12 months TTM yield is modest, around 0.61%. The payout ratio is quite low, about 18.58%.
Low payout means is pretty safe.
Yeah, it suggests the dividend is stable and sustainable. But its main function is probably signaling financial maturity and stability rather than providing significant income to shareholders. The buyback is the main event for capital return right now.
Got it. Let's move into part 3 then. Market and technical views. How are the analysts, the market reacting to all this? This high-stakes strategy, the short-term financial pain, balanced against the long-term AI promise.
Well, the consensus seems overwhelmingly focused on that long-term AI payoff. If you look at the average one-year price target from I think it's 39 analysts covering the stock, it's $186.03.
$186, okay.
And the average brokerage recommendation is 1.8. On the typical 1 to 5 scale, where 1 is strong buy, 1.8 translates to a pretty strong outperform or buy status.
So the theme is, look past the current FCF dip, value the AI runway.
That's definitely the prevailing theme, especially given the recent, quite dramatic price target increases we've seen.
Right, tell us about those. They illustrate how quickly the market view seems to be pivoting.
They really do. We saw multiple major banks recalibrate their models, and they specifically cited the accelerated cloud capex as a key reason. JP Morgan, for example, made a huge jump. They raised their target from $170 all the way up to $245.
$170 to $245.
Yeah, just on October 1st, maintaining their overweight rating. They're explicitly valuing that AI infrastructure build-out and the potential dominance of the Quinn models.
Yeah, any other.
Jefferies also raised its target significantly, from $178 to $230, citing remarkable progress in AI. And Morgan Stanley, as we discussed regarding their cloud growth forecasts, they raised their target from $165 to $200.
So this shift really indicates the market is willing to tolerate, even reward, the profit sacrifice. As long as that capital spending is clearly focused on these high-growth, potentially high-margin future businesses like AI cloud.
That appears to be the core conclusion from the analyst community, yes. The capital being consumed, that negative FCF, it's being seen as good spend by the street because it's being deployed into AI infrastructure, a sector everyone expects to grow exponentially.
And this sentiment probably explains why the stock has already had such a strong run this year.
Absolutely. That analyst confidence combined with the buybacks has fueled a significant rally. The stock was up, 113% year to date as of the end of September?
But even after that huge 113% rally, there's still this persistent narrative that Alibaba is trading like a cheaper tech giant. Does the valuation data still support that idea? Is it still discounted?
It absolutely does, yes. Even after that big run-up, the company remains, you could argue, significantly undervalued relative to its own history, and especially relative to its global peers. And that's largely due to that persistent geopolitical risk penalty we talked about.
So the PE ratio, again, was
around 21.38 on a trailing 12 months basis.
And how does that compare, just to give context?
Well, historically, that 21.38 is still a full 34% below Alibaba's own 10-year historical average PE, which was closer to 32.19. So the market hasn't fully restored its past premium valuation yet.
And compared to peers, like Amazon or Mercado Libre.
Yeah, compared to global tech peers in similar sectors, the discount is pretty stark. Alibaba's 21.38 PE is significantly cheaper than Amazon, which currently trades around, say, 33.25 PE. And Mercado Libre often trades at a much higher multiple, maybe around 55.5 PE.
So the market is still applying a significant penalty, effectively demanding a lower price for taking on that exposure to the geopolitical risks and the intense domestic competition.
That seems to be the case. You're getting the growth potential, but at a discount because of those overhangs.
Okay, let's briefly touch on the technical picture. The price per ADS as of early October 2025 was around $189.34. You noted it rallied a lot. Where does that sit in its recent range?
That price, $189.34, is right near the very top of its 52-week range, which was about $80.60 on the low end to $192.67 on the high end.
So trading near its yearly highs, what does that tell us technically?
Well, being near the top of the 52-week range definitely confirms the strong upward momentum we've seen, likely fueled by that strategic clarity and the positive analyst upgrades. The stock's showing significant bullish technical behavior.
But hitting the top of that range, does that also mean something else?
It does. Hitting the top of that range, near $192.67, means that level acts as immediate and potentially significant technical resistance.
Resistance meaning it might be hard to push past that price.
Exactly. The ability for the stock to decisively break above that $192.67 level and then sustain that higher price would signal a major technical breakout. It might indicate that the market has finally discounted those geopolitical risks enough to fully embrace the AI and cloud growth story.
Okay. And conversely, if the stock pulls back from that resistance level, if it can't break through, what support levels should the learner maybe watch?
Well, first major area of psychological and technical support would likely be around the previous highs established earlier in the year, probably clustering somewhere in the $165 to $170 range.
Which aligns with where some of those analyst targets used to be before the recent upgrades.
Precisely. A break below that $165, $170 level, especially if it happened alongside some negative news maybe on the geopolitical front, or maybe data showing that quick commerce investment isn't gaining enough traction that would suggest the rally might be stalling or consolidating.
So it really sounds like Baba is facing a kind of moment of truth here, testing both that technical resistance level and, maybe more importantly, the market's long-term conviction in this expensive AI pivot.
That sums it up perfectly. The Q2 results really show a company deep in a critical strategic transition. Yes, the short-term non-GAAP profit and especially the free cash flow are being deliberately sacrificed. That FCF outflow is a direct result of their strategic choice, not a sign of failure.
Right.
But at the same time, the underlying business units that matter for the future cloud and international commerce particularly are showing strong double-digit growth and efficiency gains. And that validates the strategy, at least directionally.
So for you, the learner, the takeaway is?
The takeaway is that Baba isn't really a simple growth stock based on steady profit increases right now. It's become a massive capital expenditure play. You're essentially betting on the successful execution of two very high-cost, potentially very high-reward strategic rollouts in AI, cloud, and quick commerce.
Okay, here's where it gets really interesting for me, thinking longer term. Alibaba is committing that $52 billion to AI infrastructure in just the next 3 years. Again, more than its entire prior decade of investment combined.
Yeah, the scale is staggering.
So, the provocative thought is this. How quickly must that triple-digit AI revenue growth continue to accelerate? And maybe more crucially, how rapidly must that free cash flow recover from its current negative state to actually justify that monumental capital outlay? Especially while they're still facing those ongoing twin pressures, fierce domestic competition, and that chilling effect of geopolitical uncertainty.
That really is the multi-billion-dollar question, isn't it?
It feels like the answer to that question is what ultimately determines whether Baba can finally break through that technical resistance near $192 and actually return to trading at its historical premium valuation.
Couldn't agree more. The execution over the next couple of years will be absolutely critical to watch.
Finally, if you have any other stocks you'd like us to cover, please let us know. Don't forget to like, share, and subscribe to support our team. Thank you.